You do not choose the invisible price tag, but it chooses you every time the Fed shifts interest rates. That single decision can add $279 to a homeowner's monthly bill, spike your credit card costs overnight, or wipe out your savings advantage in weeks. The real question is not when the Fed will move. It is how quietly that move slips into your wallet. So what is the hidden chain reaction behind your next bank statement? A first-time home buyer sits at the kitchen table, staring at numbers that do not add up anymore. The original plan seemed solid. Borrow $300,000 at a 4.5% fixed rate. Lock in a monthly payment of about $1,520. And finally, step into a place of their own. But when rates move, the math changes fast. Now, with a mortgage offer at 6%, the payment jumps to $1,799. That is a $279 increase every single month, enough to turn a manageable budget into a scramble for extra cash. For many, this is not just a spreadsheet problem. It is the difference between qualifying for a loan or getting priced out, between building equity or staying on the sidelines. The stress does not end with the signature. Every rate reset, every Federal Reserve announcement, ripples down the chain until it lands here in the monthly bill. The question hangs in the air. Who decides these numbers? And how did a distant policy meeting end up costing so much at home? A family sorts through a pile of credit card statements, searching for a reason why their balance keeps growing even after cutting back on spending. The interest line on the page stands out. Last month, it was $83. Now it is $96, just for carrying a $5,000 balance. Most credit cards set their rates using a formula, the prime rate, which moves with Federal Reserve decisions, plus a margin the bank adds on top. When the Federal Reserve raises rates, the prime goes up, and so does the card's annual percentage rate, sometimes within a single billing cycle. Unlike fixed loans, these rates are variable by contract, and issuers are required to give 45 days notice before hiking rates. But the compounding effect makes the pain immediate. Over a year, a $13 monthly difference adds up to $348 extra in interest. For many households, the cost of borrowing quietly ratchets higher month after month, with each Federal Reserve move echoing through the fine print of their agreements. The weight of debt grows heavier, and the margin for error shrinks. A saver watches rates flicker across their phone screen, weighing the next move. High-yield savings accounts soared above 5% in 2023, tempting anyone with spare cash to chase the best headline rate. But every Federal Reserve meeting brings a new twist. When the central bank hints at cuts, those tempting yields can slip away almost overnight. Locking money in a certificate of deposit promises safety. Some savers grabbed 5% certificates of deposit in late 2023, securing that rate for a year or more. The trade-off is clear: flexibility versus certainty. Pulling money out early means penalties, but waiting too long risks missing the peak. Online forums fill with stories. One saver moved $50,000 from Ali to Marcus for an extra half percentage point, pocketing $450 more in a year. Others stuck with early certificates of deposit and watched as savings account rates dropped to 4% by late 2025. Their locked-in returns suddenly looking wise. Every decision carries a risk. Chase the next bump, or settle for a sure thing before the tide turns. Every decision at the Federal Reserve starts with a mandate that sounds simple, but it shapes the price of nearly everything you buy, borrow, or save. Congress gave the Fed two main goals: keep prices stable and help as many people as possible find work. This is called the dual mandate, and it is the North Star for every policy move. The Fed's main target for price stability is 2% annual inflation, measured by the Personal Consumption Expenditures Price Index, known as PCE. Unlike the Consumer Price Index, which tracks a fixed basket of goods, the Personal Consumption Expenditures Index covers a wider range of spending and adjusts as people change their buying habits. It gives a broader, more flexible view of inflation across the economy. But even within PCE, there is a twist. The Fed pays special attention to core PCE, which strips out food and energy prices because they swing so wildly from month to month. In mid-2022, core PCE inflation soared to 5.4%, far above the 2% goal. That spike triggered a series of aggressive rate hikes and made headlines for months. By late 2025, core PCE cooled to the high 2% range, signaling progress, but not a return to the Fed's ideal. Every FOMC meeting revolves around these numbers. Are prices rising too fast, or is the job market weakening? The answers guide every rate decision, and the ripple effects land in the wallets of millions. Inside a closed room in Washington, 7 members of the Federal Reserve Board of Governors sit alongside 12 regional bank presidents. This group, called the Federal Open Market Committee, FOMC, meets 8 times a year. Not every president votes each time. Only 5 join the 7 governors to cast ballots. The president of the New York Federal Reserve always holds a vote, while the other 11 rotate yearly. Each decision sets the federal funds rate target, the overnight rate banks use to lend to each other. Right now, that target sits in a range of 3.5% to 3.75%. The funds rate is more than a headline. It acts as the anchor for short-term borrowing across the economy. When the FOMC adjusts this rate, banks quickly follow suit, changing what they charge each other and, soon after, what they charge customers. The prime rate, which many banks use to set credit card and loan interest, typically sits about 3 percentage points above the funds rate. So, if the Federal Open Market Committee sets the funds rate at 3.75%, the prime hovers near 6.75%. This link is what makes a policy move in Washington show up as a higher or lower payment on a family's next credit card statement or loan offer. The path from the FOMC's vote to a household bill runs through these benchmarks, shaping the cost of money for everyone. Beyond changing short-term interest rates, the Federal Reserve holds another powerful lever: its balance sheet. At its peak in 2022, the Fed owned $9 trillion in Treasury and mortgage-backed securities, a legacy of years spent buying bonds to support the economy. But since then, the Fed has been letting these assets roll off, a process called quantitative tightening. By late 2025, the balance sheet has shrunk to around $6.8 trillion. This slow unwinding means fewer dollars chasing bonds, nudging long-term borrowing costs higher across the board. Mortgage rates, business loans, and even government borrowing all feel the effects, even if the overnight rate stays the same. When financial markets get jumpy, another tool comes into play: the standing repo facility. In December 2023, banks tapped this backstop for $2.55 trillion in a single week, borrowing cash against safe collateral to keep credit flowing. These behind-the-scenes moves rarely make headlines, but they shape the cost and availability of money in ways that ripple far beyond the trading floor. Every rate move comes with a trade-off. Pushing inflation down often means putting pressure on jobs and growth, while easing up can help employment but risk prices rising again. The Federal Reserve watches 3 main signals before acting: monthly inflation readings, jobs data like payrolls and unemployment, and overall economic growth. These are the data buckets that shape every decision. But even experts do not always get it right. The Fed's dot plot, which shows each policymaker's best guess for future rates, has missed by as much as half a percentage point compared to where markets expected rates to land, enough to jolt mortgage quotes or stock prices in a single afternoon. For anyone trying to stay ahead, a simple checklist helps. Track the FOMC meeting calendar. Watch for the monthly CPI and PCE inflation reports, and check jobs numbers on release days. Small changes in these numbers can shift market expectations weeks before the Fed votes, moving borrowing costs and savings rates before any official announcement. Keeping an eye on these signals lets you react early, sometimes before the next bill arrives. Every Fed decision redraws the lines on your financial map, often before you notice. In a world where the cost of money shifts with a headline, staying alert isn't just smart, it's essential. The next rate move will reach your wallet, whether you're ready or not. Stay curious.